On the podcast with us today is Kyle Jones. Kyle, welcome back to the podcast.
Thanks, Dan. Glad to be back.
Well, I know there's some people that have probably not heard about you before, even though this is not your first time on the podcast with us. But before we dive into this Roads Ferry Apartments deal, which is 100 units out of Huntsville, Alabama, talk to us a little bit about yourself and your background and where you are right now as far as the multifamily side of things.
Sure. So I'm based in Houston, Texas, and we primarily focus on larger apartment buildings, minimum of 100 units plus all the way up to 250 units. And we're doing a ground up construction deal right now as well. But our bread and butter is on the value add existing assets. So the name of my company is called TruePoint Capital, and we run lean. We've got a lean team of resources, but we've got some great people around us that make up our team. And we're primarily focused in the southeast part of the U.S. So you mentioned Huntsville. We're very active in Huntsville. We're also finally starting to get into the Houston market, which is where I am based, but we just haven't, we haven't invested here in the past because there's been just pricing war and all that in hot Texas markets. So we're very active here locally now. We're very active still throughout the Southeast. So we're just still continuing to try to grow. We're still obviously buying deals, looking through a completely different lens now, post 2020 and the whole COVID pandemic. So there's a lot of lessons learned just through that in itself. But that's kind of where we're at, and we raise private capital to go buy these buildings, like a lot of your folks that you have on. So
yeah. Well, let's dive into this one, because I know in the green room we were talking about it just a little bit, and you mentioned that this one was put under contract right around the height of the beginning, really, of the pandemic starting, and kind of like that February, March, April timeframe, and you were still able to close this deal, but definitely had some interesting things happen throughout this project. So let's first get started before we dive into some of those issues. Let's dive into how you found and sourced this particular project.
So this one just came from one of our broker relationships that we've bought multiple deals from. So this is a repeat deal for us with this particular broker. We're on the front lines with this particular person just because we've performed well for him in the past. And so he did actually take it to a full market cycle, but we got to look at it for several weeks in advance. Actually, taking it back now that I'm thinking about it, we knew about this deal at some point selling about 18 months before we actually closed on the property. So we were just kind of in that position. As an older guy, he actually developed the property himself. It was built in the early 80s, and he still owned it, still managing it himself. And he was finally starting to move on, and he ended up kind of declining in health towards the end of the cycle. And unfortunately actually ended up passing away just 2 weeks after we closed on the property. But we had some lead time ahead of it, and we knew about it coming up. So we had plenty of time to look at it. And, we had already bought a property that was about 2 miles from this property itself. So we knew the comps, we had a really good handle on the area itself and already had our team there.
So you kind of brushed over the fact that this one was just given to us through a broker, through our broker relationships. But I don't think a lot of people really fully understand the importance of those broker relationships.
Yeah. So, I think a lot of people who are mainly the newer folks that are coming into it, they think they've got to get direct to seller because maybe they just aren't being taken seriously by a broker, or they're just new relationships with a broker. But at the end of the day, I mean, this is just Kyle Jones kind of guess, but I think there's probably about, over 90, maybe even over 95% of the larger apartment buildings are going to be traded with a broker involved. So they control the deals in this space. These are large commercial assets, so it's not just mom and pop shop that has a 4-unit type of a deal. I mean, there are those still types of owners out there, don't get me wrong, but you better believe the brokers are still calling those mom and pop owners to this day. So the importance of engaging with the existing brokers in the market and anybody else, meaning any of the other brokers who could potentially be calling into that market, is critical to just success and getting a leg up, because that's the name of the game. I mean, if you can get there first, there's a lot of good indication that you're going to have first shot at that deal. Obviously, there's still a price that they want to hit. So if you can get close and you've performed well for the broker in the past, which is kind of how we were in that good position here on this deal. That's why it's so critical. So, it's really, I can't remember if we talked about it on your podcast last time. I think we did, but it's really just about building rapport with the broker community. You've got to, you need to learn the terminology. You need to learn to understand how to truly underwrite a deal. You need to learn to be able to talk to other comps in the area so that you can really engage in a knowledgeable conversation with the broker before you just call them up and say, hey, what's the whisper price? And then submit your offer and wonder why it's going nowhere. Because and even in this market, there's still probably, depending on the market, 10 to 20 to 30 offers still being pushed through on any particular asset that's being marketed. So it's really just about trying to find those pocket listings, which is basically still a broker controlled deal, but it's maybe not fully marketed yet. So maybe they're going to take it to market in a month or so if they don't have any hard offers day one. So, I feel like I'm kind of rambling there a little bit, but that's just kind of my take on the broker community. And because when I first started, I was still working in corporate America selling software for IBM. There's no way I had time to build this system to just start sending out all these mailers to the mom and pop community. So, my sales background, helped me engage with the broker community and just trying to build rapport with somebody. But I mean, you don't have to have sales background to do that. It's just striking up a conversation with them, talking shop and taking them out to coffee and showing your face.
Well, I will tell you that I'm reading a book right now called Who, Not How by Dan Sullivan. And it's actually goes along with this same kind of idea of don't try to figure out how to find these different mom and pop operators. The brokers, that's what they get paid to do. That's kind of what they're there for. So let them do what they know how to do and then bring you the deals. And all you have to do is build relationships with one person, right? Or a couple of people in a market that are the major kind of multifamily brokers in that market. And let them do all that legwork and just, pay them out of the proceeds or whatever from your property. So that book is written to kind of teach you not about who it's about trying to find people that, already know how to do something, leveraging them to be able to, scale and grow.
I'm all about leveraging in more the ways than just, debt. It's leveraging your people, and not in a condescending way. It's just leveraging your team, leveraging your resources around you. It's, nature, whatever that is, just all about, trying to put yourself in a position to go out and do a deal if that's what you want to do.
So you mentioned earlier when you were talking about how you found this deal that you kind of had early access to this thing where you had seen it for 18 months prior to, getting it to the point of closing it. So what was it earlier on that you saw about this deal that made you kind of stop or pause, or maybe, was there something else going on with the property that you were not able to submit an offer on earlier on?
Yeah, we definitely tried to submit, and we did submit offers early on. He just wasn't ready to sell. But the biggest thing was just where the market rents were. I mean, and it's proving itself now that we have owned it and operated. I can tell you that, this isn't just a broker $250 increase on rents that we're talking about. That's legitimately what we're getting here. And I think we saw a little bit of that coming into it, especially because we already had the other 171 unit property in the market just a couple miles away. And we knew that what we were getting on that property compared to what he was getting. And this Roads Ferry property it was in a better location too. It sits right on the river. It's got a nice little park around it. So there's, and some good sized homes. I mean, some of these, they're some more townhome style homes, but they're probably, somewhere in the 200 to 250 range, which is, depending on your, if that's in California or New York, that's not a whole lot, but that's actually in, Southeast, that's a decent sized home. So, it was just a lot of things, the location, the opportunity to raise rents, and it was just already a clean property. I mean, these units too, just to put it in perspective, it was made up of just half and half ones and twos. The one bedrooms are anywhere from 1,000 to 1,300 square feet. One bedroom.
Wow.
One bedroom. And the two bedrooms are a minimum, I think, of 1,100 square feet up to 1,500 square feet.
Wow.
So they're
huge.
big units. They're big.
I saw an article just come across my desk today. This is, January 2021, where a lot of new developers right now are changing their floor plans to be bigger floor plans because they're making way for people who are going to be working from home more because of the pandemic. And so that's going to be interesting to kind of see how that property performs being already a large, floor plan.
Yeah, I'm excited about it. I mean, I wish it was larger, but what you said on the development side, that we are going through that now. We've already, selected our floor plans for our ground up construction deal as well. And that's exactly something that we took into consideration. They're slightly larger than market on the square footage. They also have a true workstation where it's not just where somebody living in an apartment would have to work at either the business center or their kitchen table. We actually are, carving out a little section, kind of like where a coat closet might have been in the past, or we're kind of taking the laundry room, maybe a little piece out of that, but we're just carving out a place where you could, have a good sized desk, just kind of like a school sized desk, but you could still put a couple monitors up there and have a keyboard on there if you needed to. So, and that's going to be in every single unit.
I don't know, Kyle. My school desk when I was growing up couldn't put 2 monitors on it.
Well, maybe not. Maybe bad the comparison. Maybe 2 school desks side by side.
So you obviously finally got this deal under contract. What were or before even you got under contract, what were the negotiations like towards the end there when this gentleman started to get a little more motivated to want to sell?
Well, unfortunately, he kind of started pulling back a little bit on being motivated to sell.
Mm-hmm.
I don't really know the reasoning why. I think it was just honestly, kind of a sad story, but because he was in poor health, I think he kind of knew that this was probably the thing that was kind of keeping him alive. And I think that's really the only reason why, he was being more difficult towards the end of that because, so you mentioned we put this under contract. I can't remember exactly. It was January, February timeframe. Pandemic hit. I think for me, it really became real, I should say, when the NBA shut down and we were on spring break when that happened in San Diego. And we were right in the middle of trying to close this deal. We were literally 2 weeks from closing this deal. We were supposed to close late March. And that's when the lender pulled out. So we were, because the rents hadn't been increased at all, the gross income was lower than, what would look comfortable to go into like an agency loan. So we were doing a bridge debt, but we could see it. That's why we were comfortable with the bridge debt anyways. So we actually had to pull our extension. Thankfully, we had the extension in the contract, but we only had one. So we knew that it was crunch time. I mean, it took a very long time just to find a lender because no bridge lenders were lending at this point. Everybody, even the guys who said that they'll never happen, they've got a fund and everything else. Well, their fund was not lending. So we finally found somebody, and I actually had the relationship through, we had mentioned it, but I have a residential appraisal business where we do appraisals, obviously. And one of our lenders was actually a hard money lender. And I just at this point, I was calling all of our hard money lenders and I asked them, I said, hey, have you guys ever done multifamily? Would you consider it? I said, I'll pay your traditional single family pricing, which is even above, what we generally see in the bridge market today, which is like in the 10% range. And so they didn't care. So, they finally said yes. And we were able to close from start to finish in about 3 weeks from engaging them. But that was a very stressful time because, I had quite a bit of money locked up in this deal that was non-refundable. And he was being difficult. And he straight up told the broker, he said, if this goes a day past the contractual date, he is going to take this back to the market and try to get a higher price. So we knew we had that against us. Thankfully, we closed literally the day before that date. But even then, he was still being kind of ornery and difficult a little bit. And so, to the point where he completely, he was signing. He was at this point he was on hospice, so he was in his home. And the story was that his attorney went over there And because they got the broker on the phone because he was refusing to pay the broker fee. So he said, I'm not paying you this fee. And he just kind of pulled one of those, if you don't like that, you can sue me. I mean, what's this guy have to lose at this point? So, this was my broker relationship. So I said, you know what, pull that fee, just pay it out of our side. We'll pay it. Let's just sign this deal, get them to sign it today. And that's kind of how we close that deal.
Wow. I am. So let me ask you this, as you were going through that, because obviously the first lender pulls out, you kind of like, you're kind of like in that freak out mode, right? Because you got all this money that's up for due diligence, that's non-refundable, inspection fees, whatever, as well as, the earnest money deposit. What did you go through in your head? Like how many phone calls did you end up having to make for? I'm sure you probably called every bank, every bridge lender, every broker lender. I mean, you probably made a ton of different phone calls or contacts with these different people.
Yeah, you know what, Dan? I might start a financial brokerage after that because I think there's a lot of opportunity in that because I've made so many relationships. But literally, I just went down a list and frankly, I had engaged a couple brokers, but they weren't really putting in much effort either because, their business was, they weren't able to find anybody. So, not only that, the stress of that particular deal, but this was also kind of, this was going in before April where I don't know if you experienced this, Dan, with your properties, but from like mid-March to April, everybody was like, what's going to happen with rents and come April? What's this really going to do to our property? So that was probably one of the most stressful times I've encountered as an operator in my career. But we were trying to close that deal, and then at the same time, just praying everybody was going to pay rent on the first come April, and that this whole pandemic was just going to try to move through efficiently, smoothly, and just not take too much of a hit. I mean, we knew we were likely going to take a little bit of a hit on some of our existing assets, but just try to soften the blow a little bit. So that 2 to 3 week period was not fun. And I lost a lot of sleep actually.
Mm-hmm. I bet you did. I can imagine.
Yeah.
So what's the vintage of this property?
It's built in the early 80s,
80s,
81, 82-ish, I believe.
Okay. And I figure with this particular property being 100 units, right about 46,000 a door. Is that correct?
Yes.
So 46,000 a door, C-class property, typical C-class.
Yeah. With the exception of in an area. I mean, it is a true B area, B+ area even.
Okay. Rents are organically without renovations under market or with renovations under market?
Even with renovations, we're still under market. So he hadn't raised rents in like 6 years prior to us closing it. And
he's trying to maintain.
And that 7th year, he raised it $25. So, I mean, just to put some real numbers to paper, it was so the 1 bedrooms were going for about $450 a month, and the 2 bedrooms were at like $550. Everything was under $600.
Wow.
In this day and age.
Wow. That's definitely some good opportunities there, especially with those slides of the floor plans like you were talking about.
Yeah. Well, and he was very particular about the tenant base as well. Mm-hmm. This wasn't like a, crime-ridden area. It was mostly fixed income. He kind of ran it like a senior housing type of a property. Mm-hmm. So there's a lot of older tenants very much in his demographic, just kind of on fixed income. So mm-hmm. we had that going for us, at least. Mm-hmm. We were able to kind of convince the new lender coming in that, hey, despite us being in a pandemic, majority of these folks are on Social Security. So that, they didn't stop paying rent.
Yeah. So I want to dive into the financing here in a little bit, but before we do that, we got this deal under contract now. I say you get this deal under contract and you're now in this due diligence process. Obviously lender backed out towards the end. You were able to kind of secure another alternative lender, but what kind of things came out during the due diligence period? Anything exciting?
Just that they have this like sewage pump, this pumping station that mm-hmm. had to take the water kind of up a hill. Mm-hmm. So I had never really experienced that before. Mm-hmm. But that's something, thankfully, my property manager had. He'd been around and they even, come from a development background. They developed 150+ plus properties when they were doing it. So, but that was new to me. So thankfully they had just replaced it. So there's really, the lifespan on that is another 20 years. And it's got a pretty long warranty on that, but it's literally, kind of pumping the water up to the sewer line that's kind of uphill. So I'm doing that with my hand going at an incline because that's
for those of you who are listening to the audio.
Right. Right. So that was unique, but everything else, only kind of confirmation for what we saw. Very well built property, structurally very sound, no major issues. So he took care of the property.
Let's talk about the financing here for a little bit. So obviously we talked about the first lender backing out, and now you have this hard money lender with some traditional residential terms. What's the plan for that? Are you planning on continuing to hold on to that particular debt, or have you already, transitioned over to a different type of lender at this point, or what's kind of the game plan there?
So we are looking at, we will probably refinance out of that at some point this year is the plan. Either into an agency loan or maybe into just another bridge loan now that the market has softened a little bit with just some little bit better terms. Cause we're paying, 10% on that.
Mm-hmm.
So, traditionally pre-COVID, you could still find bridge debt for anywhere from, 5 to 7.5%. So it's still better. There's still some room that we could do if we wanted to refinance it that way. So those are a couple options. And then of course, community banks are good options especially for this type of property, because it's a well-known asset in the market. So, the amortization period is not as great, but we can still probably capture some lower interest rates when we do that. So, the terms aren't great, but, right now it's working. We were able to increase our gross income by about $10,000 up to this point without, we haven't even owned the asset for a full year yet. So it's got some good momentum going into the new year that we're still not done. I mean, we've only renovated about probably 15 to 20-ish units that are at the new rate. So we've still got some headway to go.
Now, as you're renovating the units, obviously you're increasing the rents and achieving those. But what about people that, obviously you've been into this thing for, several months now. So are you seeing that you're able to increase the rents for the residents who are just basically renewing their leases and staying there? Or are you trying to just kind of maintain them until you do the renovations?
We're doing a small increase, just kind of like an inflationary increase. So, we're trying to get $50 on the renewal. But some of them just flat out aren't able to pay that. And, some of them have been living there. They're probably the property for 10 years.
Yeah.
So, we even had one person, actually two people, one that actually passed away right when we took over, one that's still living there that were some of the first residents that moved in. So they've been living there since the property was built. So, we're aware of that. We want to work with those folks who have been there a long time. We're not trying to put anybody on the street by any means. So, we're going to work with them. And we know that as long as we're just doing what we know we can do with the natural attrition that is happening with people moving out and just, coming and going type thing, we can make up for it that way. So especially right now too, where the good residents who are paying on time with zero late fees or anything like that built up, we're going to work with them right now, at least until the dust settles completely with the pandemic.
Mm-hmm. So interior renovation wise, how much are you planning to spend? And with that spend, what are you planning to renovate?
So it's anywhere from some units we've spent as little as maybe $1,500 a unit.
Mm-hmm.
Some we've spent closer to $5,000 to $5,500 a unit because these are big units. So that a lot of floorings, a lot of floor to cover in those big units. And that's the biggest expense, as you know. So, but we are on the ones that need it from top to bottom. It's flooring. There's some nice, pretty baby blue carpet still in a lot of these units too. So we're taking that out and, putting in the vinyl plank flooring, new fresh coat of paint. We're changing out the countertops and putting just kind of a fresh Formica still. We're coming back with Formica, but we're doing a spray top for mica, so it kind of gives it that little granite look. We're changing out the cabinets that need it. For the most part, we're saving the boxes, but changing out the doors, putting the shaker style doors. So really just kind of modernizing the entire gambit, new light fixtures, coming back with brushed nickel, new doorknobs and everything like that. Kind of doing a reglaze on the tubs and the tiling in there, in the bathrooms. So we're trying to salvage what we can. But, for the most part, a lot of the units still need a major overhaul, especially the ones where the residents have been there a while. But surprisingly too, I say that we have been pleasantly surprised where, we've had a couple people who have bought homes or moved out, that were just really good residents altogether that have been there, 5 to 10 years or so. And they left the property very clean for us. So it's really just a matter of, changing out that sweet baby blue carpet and, just kind of modernizing the entire unit itself.
Mm-hmm. What about the exterior?
Exterior does need a little bit of work. So we are going to have to go back and paint the exterior, paint the siding. There actually is on one of the sides. So picture there, the main street kind of splits the two halves of the property. So half the units are on one side, half the units are on the other. And they were actually built at two different times, which is kind of how that happened. The owner had both parcels. So technically they're actually two different tax parcels too. But so it has a little bit different feel. It's got siding across the majority of the property versus the other side has more brick exterior. So the siding does need to be repainted. It needs a good power washing, needs to be repainted. It's actually in decent shape, so we don't have to replace much at all. And we need to paint the trim, especially because God bless him. What he just did was he just kind of went back with this really dull gray from top to bottom. So there's really no color variation. The trim is the same color. The balconies are the same color. Everything's kind of the same dull gray. So if we just come back and put a fresh coat of paint on that and then change the color of the trim, it'll really make it pop.
So from a management perspective on this property, I'm assuming that this gentleman was the management company or the manager. He's self-managed. Is that correct?
Correct.
Now, are you planning on, or do you have on-site on this particular property, or what's your plan for management?
We do. We have on-site. So we use third party. We're kind of consolidating everything under this one particular company. But we were able to keep the management team. It's a husband and wife team, just sweet, old elderly people as well, but they know the property. They've been on the property for about 6 years. And, the wife,
do they live on the property?
No, they don't. They don't. The wife is the manager, and then the husband is the maintenance tech. And man, he has saved us in so many other cases. Cause on the other property that is close by, we actually lost one of our maintenance guys who moved to a different job. So he was just helping us back and forth. And, he was doing things we didn't even know about until after the fact on the help. So they've been extremely helpful for us through this transition. We actually, when we were doing the due diligence, I remember meeting them the first time, and he was telling me that they were ready to retire. So we were already anticipating going in there thinking that we weren't going to have the team. They said they'd stay on and do a proper transition, no problem. So we appreciated that. But we were expecting within 3 to 6 months that we needed to find somebody else. And turns out they loved it. They really get along good with our management company. And we took care of them as well. Like one of the things that we did, because Don is just a great guy and what he was doing, we ended up, there was a bonus that was actually promised to him by Mr. Key before, they were actually selling, and it never did get paid out. So we ended up putting our bonus plan in place. So we ended up closing on that deal in mid-April. So we just retroed that back to January 1 as well. So we covered a couple of those months lost, and it really, we're talking about a multi-million-dollar asset here. It was a couple $1,000s. So it really wasn't a break the bank type thing, but just the buy-in, and we wanted to do this. It was, but the buy-in that we got, and the just the rapport that we built with them by doing that was just, you can't put a price on that.
Mm-hmm.
And, and then since then, he has bent over backwards for us. So it's just been a really great experience through that, where, coming into it, we didn't think we'd get to keep him at all.
Interesting. On the structure with the investors, let's go through that. Kind of walk me through
Sure.
how you ended up structuring this deal with your investors, and how you went about raising the capital for it.
Sure. So we actually combined this property along with two other properties. So we created what we called kind of a 3-pack. We didn't create a fund to buy all 3 assets. What we did is basically, one person invest $100K or whatever. We just kind of split that across pro rata, the 3 properties. But each property still was kind of structured as a standalone deal to give us the flexibility there. So I don't know if that makes sense, but so essentially we structured all 3 of those deals the same, even as a standalone. It was just straight equity deal, 75 to our investors, 25 to the Class B, the general partners. And that's really it. We just have a small management fee of 2%, which is what we do, but we didn't do any kind of waterfall. We generally don't do any kind of waterfall from there. We're probably leaving some money on the table from our standpoint, but I think because we do that and we just do straight equity, we don't add a preferred return on every deal. I think that's helpful to help us to raise that kind of money.
Mm-hmm. So just a 75-25, no pref. What other fees do you have on top of the acquisition? On top of the asset management fee? Is there an acquisition fee, guarantee fee, disposition fee, anything like that?
We just kind of lump it all in the acquisition fee. I've seen folks, kind of break it apart, but we just, take the percentage, whatever that is, we kind of just add it all under the acquisition fee, and that's what we call it. So just the acquisition fee and the asset management fee. On that deal, we did not do a disposition fee. On some of the deals we did later in 2020, we are doing, something like that, to where if there's a capital event that's lucrative to investors, that we're still able to take some sort of fee on that.
Sure. Now, when you're doing your distributions, say are you doing monthly, quarterly? Quarterly. And did they start right away?
So we generally say, communicate, give us 6 months from closing to just get our feet under, but we'll try to make up for it where we can if if anything doesn't get distributed out. But we try to time it to be in line with the calendar quarters, so we don't have each property going off. Now it's April. Now we have properties X, Y, and Z, and now it's March or May. Now it's A, B, and C. So we try to keep everything in line so that in April we're paying out all of Q1 for all properties. So it's it's not a straight answer, but to give it a real example, we closed that property in April, I mentioned, and we paid our first distribution after Q3, which was in October.
Okay. And when you do those distributions, are they return of capital or return on capital?
So it's basically it's going towards the principal first, but it is the equity share of capital. So whatever that percentage is, it's taken off of the actual equity share for that. Okay. So we've got kind of a, our projected, the way I look at the distributions is I'm definitely looking at what we projected and stacking that up against, okay, what do we have in the bank in our operating account? We kind of do if you're familiar with Profit First. So we have like 4 or 5 different bank accounts for each property. And so the first, we're trying to maximize that the first set of funds that gets distributed goes into that Profit First account. And then we have our operating account, expense, reserves account, and everything else from there. So, that's really, I'm only looking at that profit account against, what we had actually projected. And so whatever that lump sum is, that's what we push out through our portal that gets, nicely, it's a nicely automated pro rata based on the equity.
Mm-hmm. Sure. And how did you end up raising the money from your investors? Just a typical send out an email and, people commit and funds come in, or what was
It was
it? What was the
Facebook.
process like?
We just posted it on Facebook and it all just came in. No, I wish. Yeah, it was just through the relationships that myself and my partner have cultivated over time. A lot of repeat investors, we always still get a good mix of, half and half from repeat versus new investors coming into every deal. So that's kind of how it's been for us.
And how many investors did you end up having?
Well, because that was 3 different properties, the total capital raise that we did combine was about 8.5 million. So we ended up with about 90 investors.
Okay. And what's your typical minimum that you have on your properties as far as the investment amount?
So we generally do about 50 to 60,000 as our minimums.
Okay.
I see both sides of it. I know some operators like to keep the minimums higher at 100K because you tend to get less investors that way, which is certainly helpful from a management perspective. But from our perspective, everything's pretty much automated anyways. So whether it's 50 investors or 90 investors, we've trained our investors well enough to really use the portal and, have that kind of be the first place to go to when they have questions or they want to see how the properties are doing, because that's where we post all the updates and everything else. So that's why we kind of keep the minimums a little bit lower than maybe what some of the other operators do.
Mm-hmm. Well, one of the things that we're considering is potentially raising our minimum, because our minimum has been historically 50,000. So we've never really gone below that. It's always been 50,000. And I know some operators drop down to 25,000 for the same reasons that you say. Well, it's the same amount of work for me, whether I accept it at 50 or 25 or whatever. And, so we're actually looking at doing it at 100. And kind of my philosophy on it is the people that come in at 50,000 and they're always like, what's your minimum? Okay, I'll come in at the minimum.
Always.
And if you have fewer investors, but you have more of them going up to 100, then they kind of balance each other out. So it's one of those things where you could potentially maybe even raise more money to be able to do by raising that minimum instead of keeping it at 50. So we're playing with it as well. We haven't actually made a final decision on it yet. So it's definitely something I'm always curious about.
Yeah, it's always like you're kind of waiting for that smaller deal so that you can test it out first. So they kind of drop the minimums if you need to. But we're in the same boat, and we did that. So we didn't go up to 100K. We raised it from 50K to 60K. Of course, everybody's coming in at 60K. So I don't know. Maybe on the next one we'll do 65. But the concept is still the same. I think we try to keep it a little bit lower because, even as an accredited investor, even if you have a few $100,000 to invest with one particular operator, what I have found is that, especially on the first time investors, if they're just trying to get to know you, that having that third number, that 6-figure, it changes the game. So if you have just the 5-figure investment minimum and they just want to try it out to see how, the first investment goes, and maybe then they'll come in with, their couple $1,000,000 that they have to invest on the next one. We've actually had a lot of positive feedback with that specific example. So I don't know, just something to keep in mind. And, if what we did, we just asked our investors, we just went out to them and said, hey, if we did this, does this mean a lot to you guys? And, some hemmed and hawed about it. Obviously the ones who are probably more like 1 or 2 time investors and, every couple of years, aren't going to like that. But at the same time, you're still kind of being inclusive, but you're still opening yourselves up for people who do have the funds to come in and clip off 200, 300K in one investment, to try you out at that minimum 50, 60K. So I don't know. Let me know what you find out.
Yeah, no, I definitely will. I'm of the same philosophy that I'm waiting for the smaller deal so that we can test it out first.
Yeah.
But I actually just did a podcast before yours, and it was a gentleman that closed a $61 million deal, and he raised his minimum to 100,000 on that deal. And I'm like, I don't think I would have done it on that
one. Yeah. I mean, sweating bullets, just hoping that works out. But
yeah. So, well, anything else that came up, issues during this particular acquisition that might be interesting for us to talk about that we haven't touched on yet?
No, not really that I can think of. I think it's just kind of what we've seen, what we knew going into the deal. We knew that we had a shot to raise the rents like we talked about. Cause I think when when you get these broker packets, I'm sure you see the same, but as soon as you see $250 rent increases, you're looking at that like, okay, I really got to, I'm either passing on that deal or I'm really doing some extra homework on that deal through, even calling the specific comps and everything else. But in this case, we're really getting that right now. And we still feel like we're a little bit below market. So, so far things are going well. We're just looking to capitalize on the momentum that we've gained.
Awesome. We've got two final questions for you before I let you go.
All right.
First question is, what did you find that was easier during this entire process of acquiring this property that maybe originally you thought was going to be a little bit more challenging?
In hindsight, it probably, if I would have gone to that lender earlier, then, we could have probably saved ourselves some headache there. But, and that relationship was just kind of right under my nose too, from my other business. So, I had felt like I actually exhausted quite a bit of efforts before it dawned on me to go call, the couple hard money lenders that we do appraisals for, and just ask them, because most of the hard money guys in the single family space are no different than the bridge lenders. They've got a fund that they manage, but they're just more expensive. Yeah. So that was a big lesson learned. It's, just kind of really take a hard look at, and since then I've really tried to make sure that I'm capturing every single conversation that I have with specifically lenders, and making sure that I never really get put in that position again. Or if I do, I can't avoid being in that position again. What I mean is, if I am, I'm much better prepared, where I'm not having to kind of research, Google, then call. It's like, I've got a list of names and their numbers to direct contact. So that was kind of the biggest lesson learned.
Well, eventually you can just write a check for it and not have to worry about it.
Yeah. I'm telling you, I'm going to open up a mortgage brokerage shop after that.
Well, final question for you before we wrap it up here is contrasted to the question I just asked you there about what did you find that was harder than expected that maybe originally you thought was going to be a little bit easier?
Well, I think it was getting that deal actually under contract seemed to take a lot more effort, especially because, we kind of were going in, we knew that we had a lead on the deal. We knew that we were still in the number one position as long as we could get to the terms and the price that the seller wanted. But even then, he was difficult to work with out of the gate. Just really made the contract one-sided, and had to use his attorney for closing, which, when I got the settlement statement and I looked, that attorney ended up charging us almost $50,000 just to close that deal at his title company, which generally we're seeing, all in fees at the title company on a deal that size, probably 15 to 20,000 most. So he was almost double the cost. So there were some little things like that, that didn't sit well, but just the negotiation aspect of actually, just going through that process with him was much more difficult. That was the first time we had bought a property from the guy that developed the property. So there's a ton of sentimental value there. And like I said, in hindsight, it probably appears that he kind of knew that once that property was going to be sold, he might not be around for very much longer. So I think he really just he knew that subconsciously, and it was just a much more difficult process because of that.
Well, Kyle, I want to thank you again for coming onto the podcast and sharing all of your nuggets of wisdom, especially on this acquisition in the beginning of the pandemic here back in 2020. How can the listeners reach out to you and get a hold of you if they have further questions about maybe this particular deal, or maybe want to join you on one of your future acquisitions?
Yeah, I really appreciate you having me back on, Dan, and thank you for that plug. So they could reach directly out to me in my email. It's kjones@truepointcap.com. Let me say that again. It's kjones@truepointcap.com. And that's same for our website, www.truepointcap.com. And if they go to truepointcap.com/opportunities, that's where they can get added to the list, or they can go to truepointcap.com/newsletter and sign up for our newsletter, because we do a weekly newsletter as well.
Awesome. Well, thanks again so much, Kyle, for being here. Looking forward to having you on again in the future as you continue to close more deals.
Yeah, thanks, Dan. Looking forward to it.
All right. Thanks, Kyle.